In this session, we're going to discuss loan clauses. In other words, clauses that are typically found in a mortgage or deed of trust. And the first one is the acceleration clause. The acceleration clause allows the lender to step on the gas. It allows the lender to declare the entire balance immediately due and payable, usually because the borrower has not made the payments. However, it could be because the borrower didn't pay the taxes or another lien that might have been a higher priority. Could also be that the borrower hasn't paid the insurance or has not maintained the property in adequate condition. So the acceleration clause is the clause that allows the lender to declare the debt immediately due and payable. Now, a similar clause is called the Alienation Clause, more commonly known as the due on sale clause. So this is really an acceleration clause in a specific instance. In other words, it allows the lender to accelerate the debt in the event the property is sold. This, in essence, makes loans non-assumable unless the lender agrees to allow the borrower, a new buyer, to take over the payments on the loan. The term alienate means to transfer. In the Declaration of Independence, Thomas Jefferson wrote that we are endowed with certain unalienable rights, meaning rights that could not be taken away from us or transferred. Well, the Alienation Clause says that if the property is transferred, the lender can call a loan due on sale. Next one is called the Prepayment Clause. You notice some folks here have won the lottery, and if you won the lottery and still had a mortgage on your property, what would you probably do? Well, you'd probably pay it off. But before paying a loan off, you should always look to see if it has a prepayment clause. In fact, before even making a loan or taking a loan out, you should negotiate or make sure it doesn't have a prepayment clause, because a prepayment clause calls for a penalty if the loan is paid off early. Now, all FHA and VA loans do not have prepayment clauses, but some conventional loans do. So when you or your borrower are shopping for a loan, always check to see if there's a prepayment penalty. The reason lenders charge prepayment penalties is because they're probably taking the money off the streets at a higher rate of interest, let's say 6% for the existing loan, and when you pay that loan off, they can only put the money back out on the streets at a lower rate, 4 or 5%. So that's typically when prepayment clauses are called or are enforced. Sometimes if the lender can take the money off the streets, you're paying off a loan that's a 4% loan, and the current or prevailing interest rates are higher than that, the lender might waive the prepayment penalty. A defeasance clause. Defeasance comes from the word defeat, and a defeasance clause is really just a line or two in the mortgage that says when the note is paid in full, the mortgage is null and void. The mortgage is defeated. So it's just a typical provision in a mortgage that says, well, this mortgage is null and void once the loan is paid, once the note is paid. A release clause. A release clause, remember a blanket mortgage? We talked about blanket mortgages in another lesson. Well, in a blanket mortgage, there's more than one property within the same mortgage. Well, a release clause calls for individual properties to be released from that blanket loan. So remember the builder, we talked about a builder maybe having 100 homes that they're building in a subdivision. As each property buyer buys one of those homes, a certain portion of that 100 property blanket loan will be paid off. And at that particular point in time, the lender will release that loan from that blanket mortgage using the release clause. Also called sometimes a partial release clause. A subordination clause is a clause which calls for an existing loan to be subordinated to, or in other words, placed in a lower priority position to some future loan. So let's say we had a first position mortgage on the property and another loan was going to be placed, and that other loan required their loan to be in first position. So if there's a subordination clause in the old first position loan, it might call for that first position loan to be subordinated to this future loan. Now this is not that common, but it does occur, especially in private party financing. Another use for a subordination clause is in a commercial lease. Let's say that you own a property that's free and clear, a commercial property, and you're renting it to a tenant for 10 years. So that lease is really an interest that that tenant has in the property for 10 years. Now what if you want to refinance this property? And if you go to the lender and the lender sees this 10-year lease on it, the lender wants their loan to be in higher priority position to that lease. Because if they foreclose, they could then terminate that lease if they chose to do so. Whereas if the leasehold interest was not subordinated to that new loan, the lease would be in a higher priority position. And if the lender foreclosed and wound up with the property, the lease would stay on the property. So what you see commonly in commercial leases is a subordination provision where the tenant, the renter in the property, agrees to, should the owner want to finance the property or refinance the property, that they agree to subordinate their lease interest to this new loan. So those are two situations in which we see a subordination clause. Now let's talk a minute about interest rates. We understand what interest is, but are there limits on the interest rates that can be charged? And the answer is sometimes yes, sometimes no. But if there is a limit and the lender exceeds that limit, that's referred to as usury. And usury is illegal. So for example, here in Arizona, there are no maximum interest rates set by law on real estate loans. Now there are maximum interest rates set by law on other types of loans like consumer loans and payday loans. But on real estate loans, there is no maximum interest rate that can be charged. So what about the rate of interest that's stated in the note? That's called the contract rate of interest. Remember, the note is a contract. So the contract rate, also called the nominal rate or the face rate, is very simply the rate of interest that's stated in the note. Whereas the legal rate of interest, this kind of it can be a little bit confusing. The legal rate of interest is the maximum rate of interest that could be charged when there's no specified rate in the contract. Now that's pretty rare. You'd very rarely see a lender not specifying a rate of interest. But if for some reason they forgot to, there was a glitch in their computer software and typing up the note, and you went to court, the courts would impose what's called the legal rate of interest. That's the rate that the court would impose when there is no specific agreement as to the rate of interest. And it used to be there was a maximum, there was actual number that the law stated. But in recent years, because interest rates have been so low, in Arizona, the legal rate of interest varies. The amount varies from time to time based on the prime rate. So the contract rate of interest, again, the face rate or nominal rate, is the rate stated in the document, in the note. And that is typically what we have. But in the absence of a stated rate, then the courts would impose or assess the legal rate of interest. So that's our discussion on financing loan clauses. In future videos, we're going to be talking about FHA, VA, conventional financing, and the primary and secondary markets.